Federal Reserve Chairman Janet Yellen testified before Congress this past week, giving the House Financial Services Committee a moderately upbeat report on the economy. Yellen noted strong job growth, a sharp drop in the unemployment rate, and an uptick in consumer spending as contributing factors. The testimony also grabbing investor attention over her plans for the Fed's balance sheet.
The committee intends to gradually reduce the Federal Reserve's security holdings by decreasing its reinvestment of the principal payments it receives from the securities held in the system open market account. The committee currently anticipates reducing the quantity of reserve balances to a level that is appreciably below recent levels, but larger than before the financial crisis.
Joining me right now, Grant's Interest Rate Observer founder and editor, Jim Grant. Jim, it is always a pleasure to see you.
Well, thank you, Maria.
Thanks so much for joining us.
Yeah.
So, Janet Yellen spoke to the House on Wednesday, the Senate on Thursday. Very much similar discussion. Are you as worried as some people out there about the winding down of this $4.5 trillion balance sheet?
Well, I think it's going to be a very interesting proposition. As a journalist, of course, I always root for drama, so I'm not worried. I'm expectant. But let's try to demystify this balance sheet thing. The Fed holds, on the asset side of this two-sided thing, it holds about $4.5 trillion worth of things, and those things include, notably, about $2.5 trillion of mortgages packaged as securities, and that would be, not quite, but almost 1/4 of all the first mortgages in America.
Wow.
How's that? And then $1.8 trillion of Treasury securities. That's about 18% of all the government bonds and notes held in public hands. So this is an immense edifice of financial obligations. So that's the asset side. Liability side is currency. That's what the Fed kind of owes. And and bank reserves, another important component of the liability side of that balance sheet. So to give you an idea of scale, before the financial crisis, the size of the Fed's assets and liabilities footed to about $900 billion or a little less. So we've gone from $900 billion in 10 years to $4.5 trillion.
Wow.
So this has been an unprecedented and heretofore unimagined exercise in monetary improv. It is an astonishing development. We get used to it. We get a little blasé. We should not be blasé. Nor should we be blasé about the consequences, which we cannot really anticipate, of their winding this down.
Which is why Jamie Dimon, chairman and CEO of J.P. Morgan this past week, basically said, look, this is unprecedented. Let's not underestimate how big this is, because it may very well cause disruption in the markets.
Very wise words on his part, yes. There's so much that is new and different in today's monetary environment. We had last summer, we had $13 trillion worth or thereabouts of government bonds in Europe and Japan that were priced to deliver a yield of less than zero. That's a first in, about 5,000 years of recorded interest rate history. Another first is the institution of what we call at Grants, the PhD standard, which is the discretionary monetary rule by former tenured college professors, of whom Janet Yellen is the index case. So we have theoretical professors leading unprecedented monetary policy experimentation. Does it sound good so far?
No, it sounds really scary, actually. And it feels like you, too, are worried about this, that this causes disruption.
Of course,
what does that look like, Jim? What is disruption? Does that mean a massive sell-off in stocks? Does that mean a massive collapse in the bond market? What do you think?
Of course, there's two kinds of disruption. There's the happy kind and there's the unhappy kind. It seems to me that we are presently in a moment of kind of extreme hope or complacency, or I don't know what you call it, but certainly bullishness in all markets. The interest rates are as low as they've ever been, give or take a few dozen basis points or hundredths of a percentage point. Stock prices, by some measures, are as high as they've ever been valued. And overlaid on that very high valuation is the fact that I think never before in modern financial markets has valuation been less important in the musings and the plans of the people with the money.
But they are important, aren't they?
Yes, they are. Well, we used to say they are, we use a fancy word, dispositive, right? They really determined outcomes If you invested where things were cheap, PE's low, price earnings ratios low, you had a fair chance at a good outcome, profitable outcome. And if you, contrary-wise, if you invested near the top at high price earnings ratios, you were digging yourself into a little hole. That was the dogma, several hundred years before about last week.
Is this the top?
Yes, and if you'd asked me that a couple of years ago, I might have said, when I was less wise and less old, I might have said, certainly, Maria. I've become a little less dogmatic in these things as the birthdays have flown by.
Because sometimes
we don't know if it's top
things are expensive and they just could get
more
expensive.
Do they? That's been my experience in life.